Hello, everyone, and welcome to our Charitable Remainder Trust webinar. My name is Denise Chan Gans, and I am the Executive Director in the Office of Gift Planning here at the University of Chicago. And we are thrilled to know that you are coming to us as a resource for your charitable and philanthropic planning. We're so pleased that you have joined us today. And I'm going to start with a little test of your knowledge, go through an overview of how a charitable remainder trust works, what it is, and highlight some of the key benefits of a charitable remainder trust from a tax and financial perspective. And then I will turn and invite Heather George, an alum of the university, the Harris School, to join me in a conversation. She is bringing with her over 20 years of experience in the wealth planning and strategy space with high net worth families. Before I begin my discussion of charitable remainder trust, I just want to remind everybody that this program shouldn't be relied on as tax or legal advice. We really hope you do learn something that will be useful for you, but it is important to remember that you should consult your own advisors, your own lawyers and accountants for advice that is specific to you. Okay, so without further ado, we thought we would start with a little quiz. And so you are going to see pop up on your screen 3 questions. I'm going to go ahead and read those aloud. Give you a minute to answer, and then we can go over these questions together. So the first question is, what type of distributions can a charitable remainder trust make? Fixed payments, variable payments, net income payments, or all of the above? Choose one answer, and we'll look at them in a moment. The second question is a true or false question, and that is a charitable remainder trust must be funded with cash, true or false. The third question is, when does charity receive funds from a charitable remainder trust? 4 choices. Is it at the time of funding? Is it with every distribution that comes out of the trust annually? Is it when the trust terminates, or is it all of the above? I'm going to give you maybe about 20-30 seconds to go over these. Give it some thought and submit your answers. I hope all of you have had enough time to answer. I think my colleague Rachel can see. Okay, great. So let's look at these responses. So many of you chose the correct answer to number 1, which is all of the above. So a charitable remainder trust can make fixed or variable or net income payments. There can often be, the way you structure a charitable remainder trust, the ability to combine a variable and a net income payment. The most common type of charitable remainder trust that we do see is the variable payment type charitable trust, which is called a charitable remainder unit trust. And so I will spend some time in a little bit explaining how those work. And the second question we had was true or false. Can a charitable remainder trust must it be funded with cash? And the answer to that, again, many of you answered that correctly, is false. So one of the advantages of a charitable remainder trust is it is, I guess I could say, adept, or it has adaptability and receiving different types of assets that can be structured in a way that is conducive to different types of funding assets. And that would include things like appreciated securities, real estate, closely held assets. So the answer to number 2 is false. And then the third question is, when does charity receive funds from a charitable remainder trust? And oops, I have to scroll down to see the answers to this. Again, very smart UChicago crowd. The most proportion of you answered correctly, which is when the trust terminates. So it's a little bit of a, I realize, maybe an unfair question in some regards, because if the charity is serving as trustee of the trust, they will receive funds from the donor at the time of funding, but the actual availability of the remainder for the charitable purpose designated by the donor is not available to the charity until the trust actually terminates, when the income, interest, or term ends after the trust is done paying distributions to those income beneficiaries. The trust will terminate, and it is that remainder value that is distributed to the charitable recipient for its charitable use upon termination. All of you did very well. I do hope you learned something from this, and please pepper us with questions in the Q&A for everything that you want to know and still have questions about. So if I could have the first slide, please. So quickly, and I hope to do this efficiently so we can begin our conversation with Heather, George, how a charitable remainder trust works is that a donor is going to contribute assets, could be cash, securities, real estate, to an irrevocable trust. And that trust is going to make income payments of the different types we described, but most commonly a unit trust payment to income beneficiaries that the donor has designated for a term of years or for the beneficiary's lifetimes. And then at the termination of that period, the remainder value of the trust is going to be distributed to charity. Most commonly, we see donors who are setting up charitable remainder trusts with themselves as the income beneficiaries. They may include a spouse as well, and they are most often choosing to have the payments and that income stream distribute to them for the remainder of their lifetimes. The donor is going to receive an income tax deduction when they make the contribution to the trust. And that income tax deduction is going to be a portion of what that contribution is valued at when it's transferred into the trust. And for discussion purposes today, let's sort of take the assumption or the average that that deduction is going to be about 50% of what is contributed to the trust. The IRS is going to calculate what that deduction is. They are projecting in present value dollars what will be left for charity, and that is what determines the donor's income tax deduction on the front end. I'm going to get a little bit into this note about no or reduced tax on capital gains in a bit when I highlight what some of the real advantages of a charitable remainder trust are. For now, I want to explain more fully how the distributions from a charitable remainder unit trust are determined. So if you could move to the next slide. So this is a schematic, a formula showing you, a slide showing you how a trustee and a charitable remainder trust would go about calculating payments to the beneficiaries each year. A charitable remainder trust has a payout rate. It is a percentage. We, in our program, recommend 5% as a payout rate. And the annual distribution from the trust is calculated by multiplying that payout rate against the fair market value of the trust revalued annually. So if we assume that a trust is funded with $100,000, let's say on January 1, That is going to be the starting value of that trust. We would multiply 100,000 by the 5% payout rate, and that would produce a $5,000 payment to the income beneficiary that year. You can choose to have the payment made in quarterly installments or semi-annually, annually. And at the beginning of year 2, the value is taken once again on the first day of the year. And if we assume a 7.6% rate of return, and remember that there has been in the previous year a $5,000 distribution, and there will be some investment and management fees taken out, we start year 2 with about $102,000. That will again be multiplied by that 5% payout rate, which is stated in the trust agreement, and produce for the income beneficiary in year 2 a payment of approximately $5,100. So we can move to the next slide. This graph is intended to show you that the hope and expectation with the charitable remainder trust is that over time, these payments are going to grow with the value of the trust as it's revalued annually. In this scenario, we have a 72-year-old donor who contributed $100,000 to the charitable remainder unit trust. If we were to assume a 7.6% flat rate of return, which is not reality, but for illustration purposes, we would see a straight line increase of that payment from $5,000 to nearly $7,000 in about 20 years. Scenarios 1 and 2, the blue and the yellow lines, are showing you what would actually happen and what the unit trust payments would actually look like in better and worse historical performance periods. Again, the thing to remember is that payments from a charitable remainder unit trust are going to go up and down every year as the value of the trust goes up and down with market performance. But over time, the hope is that the payments will increase, and by doing so, it can really serve as a nice source of retirement income and also serve as a potential hedge against inflation, which is not the case with other fixed payment vehicles. And this slide is intended to show you really what the total benefit of a charitable remainder unit trust can provide for the income recipient and ultimately for the charitable remainder recipient. So again, we're using the same assumptions as on that previous slide. A 72-year-old donor who is also going to be the income beneficiary, funded with $100,000. Over that donor beneficiary's life expectancy, the donor is going to, in scenario 2, which is that 7.6% assumed rate of return, is going to receive back over what they initially contributed to the trust, cumulative payments of $107,000, and left for charity when the trust terminates is over $140,000. Scenarios 1 and 3 again show you what those outcomes would be for the income beneficiary and for the charity in better or worse historical market performance periods. You can see then that the income beneficiary, in this case the donor, and the charity are going to share in the sort of total up and down of the market performance over the trust period. So it is, in that sense, a shared upside and downside of what this life income split interest vehicle can do for both a donor and a charity. So I want to just spend quickly on this last slide, and we will get into this in more detail, some of what the additional really key highlights are of a charitable remainder trust. And that is that it is a wonderful way to avoid and minimize capital gains tax. As I mentioned, you can fund a trust with appreciated securities, real estate. When the donor funds the trust with an appreciated asset, the deduction is going to be based on the fair market value at the time it's contributed. The trust will typically sell that asset and reinvest it in a diversified portfolio to support the payments to the income beneficiaries and grow that principal for the remainder beneficiary. But there is no capital gains tax owed by the donor when the trust liquidates the asset once it's transferred. That capital gains tax doesn't disappear, but it's going to be deferred and spread out over the payments over the life of those beneficiaries, and in that way can really minimize the tax hit from the capital gains. And Heather's going to talk about this a little bit more, but it's a great strategy for diversifying assets that have been long held, may not be producing much income for the owner. And one of the other things I wanted to mention as a potential benefit to university alumni friends and donors is that the University of Chicago, we do have a program where we serve as trustee of charitable remainder unit trusts. A donor can appoint themselves, a bank, a trust company, their advisors or trusted individuals as trustee, but there are a lot of responsibilities involved. Opening the trust account, filing tax returns, issuing the K-1s, and obviously managing the investments in the trust and handling the administration of the trust. So we can facilitate and help set up a charitable remainder trust for our alumni and donors, and this can really be a turnkey solution that can save on the transaction costs for individuals who want to be philanthropic and charitable with the university in this way. I should mention that the minimum to set up a charitable remainder trust with the University of Chicago as trustee is $100,000. And I guess the last thing I'd want to mention is that additions are easy. Once you set up a trust, you can add to it. It's going to provide you with an additional deduction, increase your payments going forward. And so that is also an attractive feature of the charitable remainder trust for many of our donors. Last but not least, you can designate any part of the university as for where the remainder is going to go. You could use designate that the remainder establish an endowment fund, such as an Odyssey Scholarship Fund. So there is a range of things you can support that you care about at the university through the designation of that remainder to the university. So it's now my pleasure to introduce Heather George. Heather George is Executive Director and Senior Strategist in the UBS Family Advisory and Philanthropy Services team. She, in her role at UBS, serves as a thought partner to financial advisors and exceptional client families to support wealth transition, family governance, education, and philanthropy. She provides guidance and develops strategies to bridge generations and build legacy. She has over 20 years of working with high net worth families in the wealth management space. And in 2019, she earned a master's degree from the Harris School of Public Policy and serves on the Alumni Council of the Harris School. So welcome, Heather. We are so happy to have you as our guest. We feel very lucky and privileged to have you join us and share your expertise with our participants today.
Thank you, Denise. Happy to be here.
So you work closely with families who are philanthropic, but also want to manage their wealth wisely and strategically. And they also have family relationships to think about and balance. How have you seen charitable remainder trusts used by donors and families to accomplish their goals? Do you have some examples you can share with us just to sort of bring to life some of the things that I've just been talking about?
Yeah, I mean, hopefully we can bring this strategy to life, right? There's a lot of complexities. Anytime you're working on establishing a trust as part of your total financial picture, there's a lot of decisions to sift through, right? The most, I would say, attractive or the things that come to mind first as it relates to charitable remainder trusts is what you highlighted, but I think it's worth reiterating, which is the unique tax features, income tax features that the charitable remainder trust structure offers that other structures don't necessarily offer. So, number one, if I'm working with a client and I'm looking at their total financial picture, I know they have some charitable intent. There might be some tax issues going on, either a large income tax year or something on the horizon. That's when the charitable remainder trust comes to the forefront, right? Like, okay, maybe we should consider this strategy. So taxes is one, charitable intent is the other. And then lastly, it's how does this fit into a client's total financial picture, and what role could this particular strategy play? So let me bring this to life a little bit, maybe give a client example. Because of the unique tax features related to a CRT, and you talked about it a little bit, but it's again worth kind of bringing back up. When you say defer or avoid capital gains or avoid immediate income taxes, what are we talking about here? Let's just say that people on the call, like you would have maybe a position in your stock portfolio. Maybe it's a stock that you've held for a long time. Maybe that stock has significantly appreciated as part of your portfolio, right? And you and your financial advisor, potentially, or just you on your own, you're taking a look at your portfolio and you're seeing that that one position is becoming outsized, maybe relative to the rest of your portfolio. And as someone who thinks about, how do I manage all the parts of my portfolio together? One observation could be, may not necessarily be, but could be that as this position is growing larger and larger relative to my other positions, maybe I'm taking on more risk than I otherwise intended to do when I first invested in, I don't know, one of the FANG stocks, for example, right? That's what everybody's talking about, the Facebook, Apple, et cetera, Google. And so you might think, gosh, I would really like to sell a portion of my position in that stock. But if I do that in this particular tax year, what happens? The tax bill comes, right? And now I'm going to have maybe less to reinvest in my portfolio after I sell that because I have to put some money aside to pay taxes, right? So one way to actually accomplish that, to sell or diversify out of that concentrated position with low basis, is through contributing that stock to a charitable remainder trust. And then once it's in the trust, you sell the asset and diversify. Okay. That means that in that first year, when you sell that position, there's no immediate tax bill due that year. But you don't get away with eliminating the taxes forever, right, Denise? Right? The tax man always comes piping, right? So what does that mean? It means that there's a calculation based on kind of how much gains are generated on that initial sale. Like after you contributed to the trust, I'm going to sell it and diversify. There's now a bucket of capital gains taxes that the trustee is now keeping track of, right? And every year when you're getting 5% or some other predetermined amount, right, as part of your distribution as the income beneficiary, a little piece of that is going to be the capital gains that you would have otherwise paid in year one, that now you're just going to pay over the remainder of the life of the trust, right? Frequently, I call it paying it in dribs and drabs instead of all at once. right? And the benefit is now you have that money really working for you at full horsepower because you're not paying that tax bill up front and taking a big hit. So that's the most obvious case for a charitable remainder trust. I have a concentrated position. It has low basis. It would be significant tax cost to sell or diversify out of that. And I also have an organization like the University of Chicago or others, right? Frankly, candidly, many organizations, any public charity could be a beneficiary of a charitable remainder trust. All of those things fitting together really guide towards a CRT as being a truly viable strategy for a client, right? So hopefully that brings to life how this actually get utilized. But the flip side of that is someone might say, well, Heather, I have a donor advised fund, right? That's an account with a public charity that's very flexible where I can contribute low basis assets and diversify them. What's the difference between a donor advised fund and a charitable remainder trust? How do I know when to use one versus another? And the big difference is in the charitable remainder trust, you receive income potentially. You could designate anybody to receive income, but as you stated, Denise, the most common case is the donor, the grantor who's establishing the trust gets an income stream from that trust. So with a CRT, you're taking some income back from that trust, and within a donor advised fund, you're fully relinquishing basically all control of the assets, right? You're not getting anything personally. There's no personal benefit or income back to you as a result of a donor advisement. But those are probably the two most common philanthropic or charitable strategies that are usually at play within a client's financial picture. I'm going to pause and see if you have any clarifying questions or if I left anything out.
Well, I was just thinking when you were talking about the spreading out of the capital gains, I have seen donors anticipate that in the future, maybe their tax rate will be lower. Maybe they're setting this up while they're still working. And so that's another way in which, that might reduce their income tax liability over time. And I guess
100%. I think that's worth like pausing and sort of reiterating, like absolutely. So not only are you eliminating paying that large bill up front, but you might be at a lower rate in the future in retirement. The flip side of that we don't want to negate, which is that when you establish this charitable remainder trust, there's a calculable remainder interest that you get a charitable deduction for upfront, right? So whatever portion the IRS says based on, what is it based on? It's based on how much you contribute, what your payout rate is, and what the prevailing interest rates are at the time of funding. And by the way, high interest rates are actually better for that calculation where, notwithstanding everything else in people's financial pictures, low interest rates is usually better. But for CRTs, in calculating that remainder interest and how much charitable deduction you get up front the year of funding, the higher interest rates mean higher remainder interest that the IRS is going to calculate. So said another way, because you're getting an upfront, if you will, charitable deduction for that calculable remainder interest, many clients will choose to fund this, to your point, in the year when something else is going on, right? Maybe they are selling multiple positions. Maybe they're selling an asset that is going to generate significant gain. Maybe they're selling a business, right? We have many clients who are exiting maybe a business that they've been running. There's going to be a large income year. Maybe it's a bonus, maybe it's a deferred compensation payout, whatever it might be. If there's a large income year, that's another reason you might want to think about the timing of utilizing that charitable remainder trust. And let's also, I think, be transparent with folks, right, Denise? A charitable deduction, if you can't utilize it all in that first year, the IRS permits you to carry it forward for up to 5 years. So it's usually a sort of a time period within a client's financial life that we're looking at anywhere from 1 to year 6, right? And anytime in the next 5 or 6 years, can you really utilize the full value of this charitable deduction optimally? That's what you want to think about in order to really optimize the use of this strategy.
Mm-hmm. Thanks, Heather. That was an awesome explanation. We do want to make sure we give everyone time for their questions, but I do want to, because we have you for this time and given all of your professional expertise and experience over more than 20 years, what wisdom would you like to share with fellow alumni and friends on the call? What would you want them to know just from your vast experience? Before we turn to specific questions about CRT, what would you like to leave with them in terms of planning for their futures and their philanthropy?
Oh, I wish I could. How many minutes do I have? I'm just kidding. What would I say? I would say that the more sort of purposeful and intentional and strategic you can be around not only these decisions, but all of your financial decisions, all of your estate planning decisions, right? If you can really take a step back and do an assessment about what are my goals, what are the outcomes I'm looking to achieve, then you can truly discern the strategies that are ultimately going to successfully fulfill that vision. But what I find for most folks is we're all busy. We're busy professionals. And even if we're in retirement, we're probably busy doing other things like family, travel, all those projects that you put off, right? So most of us just don't take the pause and go, gosh, am I being strategic? Am I being thoughtful and purposeful? If maybe it's about a CRT and knowing that I'd like some income in my retirement years, but also benefit an organization like U Chicago that I feel so passionately about. Or maybe it's just the larger philanthropic conversation, right? I work with a lot of families, and I find that many times parents are going, gosh, we've had financial success. We want to make sure that our kids and grandkids benefit from that, but we don't want them to sort of forget where we came from, if you will, right? We want to make sure that they really understand our values and what's important to us, even though we've, helping pay for college and we're helping the grandkids, whatever the situation might be. Philanthropy is the right way to do that within a family. Just telling the stories. Don't forget to talk to your loved ones about the things that are so important to you. Whether it's, when it comes to U of Chicago, it's probably your story of education, how powerful that was, maybe what a difference that made in your life and your professional trajectory. Maybe it's other organizations in your communities that you deeply care about and that you support. I would encourage you to tell the stories of that, right? We say in our business, values are caught, not taught. And it's through these stories, through this reinforcing the things that are formative, important, that shaped who we are. That is truly an important part of legacy within families beyond just leaving a financial legacy. So if I could impart a little bit of wisdom, not related to CRTs, but deeply, deeply important for families, is take a purposeful path, to have an intentional look at where you're at, and where you really want you and your family to be over the long term, and then determine the path forward.
Thanks, Heather. I will just say, in the Office of Gift Planning, we're really privileged to hear stories from alumni about what difference the university has made in their lives, and we try to feature those as best we can on our newsletter, Building for the Future, and the university's alumni magazine is also a great source of stories